Good afternoon. I'm George McCarthy, better known as Mac, president of the Lincoln Institute, and I'm here to welcome you to another of our series of Lincoln lectures. And as you probably know, we are shaking it up a little bit this year with trying to actually string together a set of presentations on a single topic. In this case, the topic is municipal fiscal health. And for those of you who were at the last one, you know that we've been featuring a variety of different speakers who are helping us to kind of unpack the challenges of helping to keep our localities fiscally safe and sound and sustainable. It's good to see a lot of our frequent flyers, returning faces, and a few new people coming, and I hope you spread the word that this is always a good place to have a little lunch and some thought-provoking conversation. Today we're going to shake up the modality a little bit more. We're going to have a presentation from our speaker, Greg LeRoy, who I will introduce in 1 second. And then Greg and I are going to actually sit down in these allegedly comfortable chairs right here and talk a little bit and hopefully engage with you, the audience, in a conversation after the presentation. So Greg LeRoy, who is an old friend and an ally, has founded and directs Good Jobs First, which is a national resource center promoting accountability, particularly regarding the $70 billion spent annually by states and cities for economic development, smart growth for working families, and sometimes just giving away the farm, right? Good Jobs First is also home to Subsidy Tracker, which is a really interesting and important national database that really tracks subsidy awards at multiple levels of government, and presents them in the long-standing effort of Good Jobs First to promote transparency of government. And eventually we might get to transparency of the private sector too, if we're all good. So Greg is author of the Great American Job Scam, Corporate Tax Dodging, and the Myth of Job Creation, so that might give you a hint as to what he's going to be saying in just a few minutes. He's also written No More Candy Store, States and Cities Making Job Subsidies Accountable. Good Jobs First was recently honored by State Tax Notes magazine as one of the 2 organizations of the year in 2015 for its victory, winning a new accounting rule from the GASB board, which requires new accounting standards for local governments. I guess maybe all governments. Which is really a great step forward, and hopefully we'll get to the point where we actually know what all of our governments are doing. So without any further ado, let me introduce Greg, and then in a few minutes I'll join you again on the stage for a little conversation. Thanks.
Thanks very much, Mac, and thanks to the staff for the Lincoln Institute for having me back. We're talking, as Mac said, about $70 billion estimated that states and cities spend in the name of economic development. That's an estimate by Professor Kenneth Thomas. Every kind of fee or tax that companies might normally pay to support public service goes away, sometimes becomes negative even for long periods of time. And just to talk about the situation right now, it's little known that the total number of deals for which states and cities could compete actually crashed before the recession, dipped a little bit more in the recession, and as of 2014 was still not back to 47% of 1999 levels. So supply of deals has been depressed for a long time. Demand in the form of anxious public officials looking to be aggressive on the economy to get reelected has been elevated at the same time. As a result, we're seeing a spike in what we call megadeals, essentially 9- and 10-figure deals. Whereas we used to have, 5 or 10 a year, now we're having 20 or 30 of these really huge gold-plated deals per year. The Teslas, the Boeings, the J.P. Chase Morgans, et cetera, et cetera. And the cost of these programs has also more than doubled, whereas it used to be $2 to $4 billion a year in announced deals. We've had as high as over $16 billion. That was the year that the Boeing deal, the $8.7 billion deal in Washington State spiked. Maybe a little bit of relief last year. Hard to tell if that's really a trend or not. They're not unique to any particular part of the country. They're in all kinds of different industries. Manufacturing still heavily represented, but not the whole story by any stretch of the imagination. Chris Christie has set an all-time record. He's done 9 nine-figure deals at the same time as he's had 9 credit downgrades. I'm not saying there's a direct relationship, but these things happen. And 6 of those are over $200 million, actually. Nothing like having a celebrity CEO whipsawing 5 states against each other and a governor months away from his re-election fight. $1.3 billion, 2.5 times the original asking deal for the Tesla Gigafactory, the battery factory that's going to going in near Reno. We've had New York State subsidizing a foreign microchip maker to the tune of $1 million a year, $1.2 billion for 1,200 jobs. Some of those jobs have since been lost. The cost per job is higher now. But the state taxpayers obviously can never break even. These workers will never pay $1 million more in taxes than public services they will consume over their working lifetime. The mega deals that we've documented, the average cost per job was $456,000 per job. Again, all got to be net losers for taxpayers. It's even gotten so bad in the incentive game that it's not that we're just reducing corporate property taxes and corporate income taxes and corporate sales taxes. We're actually giving them other people's money. These 16 states allow 2,700 companies to keep some of their employees' state personal income taxes to the tune of about $700 million a year. Yes, we call it paying taxes to the boss. That really is what we mean by that title of the study. Only Kentucky even sort of kind of notifies people that it's happening. Nobody really knows that it's happening. Among the hurting, desperate beneficiaries of this program are Goldman Sachs for jobs that used to be located in Manhattan and then jumped the Hudson to Jersey City, so that about 2/3 of the new payroll taxes are now not going to Trenton, but instead going to Goldman Sachs. We also have this crazy situation where cities and counties grant property tax abatements, create TIF districts and enterprise zones, abating or diverting large sums of property taxes, especially for long periods of time, 10, 15, 23, 35 years. It's kind of an intergovernmental free lunch because in most states, school boards are powerless to protect themselves from this problem, even though they're the biggest revenue losers. And we think that's a crazy situation. We have this thing called tax increment financing, about which we're actually jousting with GASB right now about whether it's covered by the new standard, but it's a real issue in a lot of states. One of our favorite piñatas is the Chicago TIF program, which now covers 30% of the land area of the city. Here's one TIF district alone in the Central Loop, which diverted $1 billion almost in revenue over its 23-year life in the Central Loop. TIF was absolutely a political issue in the school closure fight a few years ago in Chicago when Mayor Emanuel closed 50 schools abruptly, mostly in poor and people of color neighborhoods. It was absolutely an issue in the teacher strike later on as well. TIF is a problem because the word blight means nothing, right? So this is a wealthy suburb of St. Louis called De Pere. It's about 20 miles from Ferguson. You can see it's a terrible location right next to an interstate. This Westfield is the Australian REIT. And they declared one day that we're blighted, because we don't have our Nordstrom yet. And the town fathers said, "You're right, you're blighted. Let's give you a TIF district worth $31 million to make sure you can get a Nordstrom and not be blighted anymore." And that was upheld at the highest court of the state of Missouri. We've documented $1.2 billion in bricks and mortar subsidies to Walmart, supercenters and stores and warehouses around the country. Obviously, it's a predatory business model, growing largely at the expense of existing grocery stores and other kinds of retailers. At a time when 23 million people are officially rated as living in food deserts by the Department of Agriculture, and now, I don't know if you noticed, the new fresh wave of closures just announced by Walmart, including the 2 food deserts they were allegedly going to address in Washington, D.C. that are not going to get a grocery store now, that where land had already been cleared and people had already been dislocated for the footprint of the stores that are not arriving. We have mapped more than 5,000 deals in 13 metro areas, looking at the geographic distribution of incentive deals through the lens of sprawl. And here's an example of the most lavish single program then existing in the state of Michigan, called the Michigan Economic Growth Authority. Every diamond is a deal. There's about 81 diamonds on that map. Exactly 1 is in the city of Detroit. Exactly 0 are in the 10 most densely populated inner ring suburbs of Detroit. They're basically redlining Detroit. This has everything to do with the city's fiscal health and lack of job creation. These are, again, the most lavish single program on the books at the time of both the Engler and Granholm administrations. And those deals occurred during both administrations. These are enterprise zone programs and so-called community reinvestment area deals in the Cleveland metropolitan area. The city of Cleveland is there at the heart of Cuyahoga County in this map. All those blue arrows are outbound deals. 80% of them are outbound. These are companies getting paid to move around within the same metropolitan area. We've documented this in the only two states where such data exists, which is Ohio and Minnesota. And if you look at these through any metric, neighborhoods that have had the most plant closings, neighborhoods that have the most tax-based stress, neighborhoods with the most poverty, highest unemployment, people of color, where people can get to work by transit or not. These are all bad news. They're taking jobs away from people who don't own cars, people away from neighborhoods with high unemployment. We've even documented that 3 out of 4 large for-profit private prisons in the United States, already profitable based on like cost-plus contracts, right, have also gotten tax breaks and other kinds of low-cost financing and economic development subsidies. We're even subsidizing lifestyle, outdoor sporting goods stores. Both of these chains, which are now in merger talks, have received more than $1 billion, Cabela's and Bass Pro, most of it TIF financing, all over the country, dozens of deals for both companies. In 2013, we had the spectacle of something we've never seen before in U.S. history. We had a governor turn interstate job piracy into a partisan sport when Rick Perry visited 6 states who all happened to have governors of the opposite political party, complete with advanced radio and TV ads featuring Rick Perry, paid for by taxpayer money despite his misleading disclaimers. And since he stopped that after we called him out on it in our study, but Governor Scott of Florida has sort of picked up the mantle and done a couple of these partisan job piracy trips since Rick Perry left office. Again, never happened before in U.S. history. I mean, obviously interstate job piracy is not new. Overtly partisan job piracy, never before seen. We also have a hyper concentration of the sort of corporate rich getting richer. Even analyzing once all the data in our Subsidy Tracker database, we determined that fewer than 1,000 companies accounted for 3/4 of the recorded money we had captured in all the disclosure online records that we compiled there from states and cities and counties. And when we dug deeper into a large sample of programs in 16 states last year, looking at programs that were facially neutral as to what size of company was receiving them, we discovered the bias was even worse, that 90% of the dollars of these programs were going to large, multi-state, multinational, et cetera, companies. And then we have this political climate out there with the American Legislative Exchange Council and the Tax Foundation and the Beacon Hill Institute here in Boston putting out these business climate ranking studies. ALEC just came out with their latest one last week. Mercifully, we also have our own Dr. Peter Fisher from the Iowa Policy Project and the new gradingstates.org website that he has just put up with constantly updated counter-analyses, kind of peering inside the black box of all these right-wing business climatology studies. At least there's a she said out there now to the long-standing he said. This is a long-going battle that dates back to the 1970s with Fantas and then Grant Thornton and the Council of State Manufacturers Association. This is the latest echo of the recurring puncturing of business climate studies that's been going on since the 80s, really, originally with the Corporation for Enterprise Development and Bill Schwecke. And despite all this craziness, when do you think the last time was that the National Governors Association debated the war among the states, the economic war among the states? Anybody want to take a guess? Nobody who heard me say this before. 1993. After that notoriously expensive Mercedes-Benz deal in Alabama, which put everybody into a hissy fit, they came up with a 2-year non-binding resolution, and that's the last time any of the governors' associations, regional or partisan, has touched this subject. They're really missing in action. We had the Cuno Supreme Court case in 1995, which came to naught in 2005 and 2006, rather. Accompanying legislation sponsored by Ohio Senator Voinovich that would have undone anything good the Supremes might have done, but the Supremes didn't do anything. It's really been trench warfare. I mean, Plan B for us has been transparency and accountability, and I'm just going to give a few highlights of things we've won, and then I really look forward to the conversation. So in 1995, Minnesota passed the really good first robust subsidy disclosure bill. They sort of cut and pasted out of my first book, No More Candy Store, that came out the year before. And then And then the trend spread, and Minnesota passed a really good bill in '98, and Ohio actually began disclosing the first internet-based disclosure in 1999 with their enterprise zone program, and North Carolina, even though they had sort of broken the bank with a new program, also became hyper-transparent and was an early adopter online. So that by the time we first graded the states, almost half of them had something or another online to some degree. And by 2010, 3 years later, 37 states had data online, although it was a Tower of Babel. Most of the data was buried in obscure, non-searchable PDF documents and appendices and reports that we weren't sure were going to stay online. And nothing was searchable across state lines. So we started snarfing it up and putting it all together in our Subsidy Tracker database that we released late that same year. Today, I think even Idaho slightly has something online. We would almost count them in the disclosure column. Delaware and Kansas were the other two last adopters. And we hasten to add that even though everybody's disclosing now, the quality of disclosure still is quite uneven, to put it politely. For instance, 3 out of 4 major state incentive programs still don't even tell you how many jobs actually got created. They tell you how many jobs were supposed to get created or were projected to get created, but they don't even give a self-reported number about how many jobs are actually coming out of the other end of the tubes. Only 1 out of 11 tell you about actual wages paid. So we've still got a long ways to go on outcome disclosure, even though we now know where the money's going, and we can talk about the distribution of money and the geography of money and the size of the companies getting the money and lots of other things that we couldn't ever say before. As I mentioned, Subsidy Tracker is our database. I really encourage you to use it. We're enhancing it constantly. It's up to almost 500,000 entries now. We added a bunch of federal data last spring. We have more than 135 federal programs in the database now, more than almost 600 state and local programs, and we're adding them more all the time. The local government is the last frontier. Local governments are still more as primitive as states were when we first started cajoling them in 2000. We determined that only about 1/3 of major large urban counties and cities have online disclosure of incentive programs that they control yet. So that's where the greatest room for improvement is. Certainly other safeguards like clawbacks or money-back guarantee language used to be exotic European imports are now commonplace. Almost the vast majority of major state incentive programs do provide some sort of penalty for non-performance. And even if they don't have wage standards, which we'd like all of them to have, 45% of them have that, almost all of them have something that's supposed to come out of the other end of the tubes against which companies are held to a penalty clause, which it may be capital investment, it may be workers trained, it may be jobs created. That's all progress, and that we think has a lot to do with the spread of transparency and investigative journalism and nonprofit activism that's been going on from so many angles for so many years. We also hasten to let people know that there is in this whole issue of the war among the states and interstate job piracy and intrastate job piracy, and the latter, intrastate job piracy, is a much bigger problem, frankly. We think much more common than interstate job piracy. There is hope. And the two best places are Denver and Dayton, where for more than 20 years, regional economic development organizations have had systems in place whereby when a local government belongs to the regional economic development entity, as a condition of belonging, you cannot actively pirate jobs from your neighbors. And if a company knocks on your door and says, I'm thinking of leaving your next door neighbor and moving over here, you have to rat out the company to the incumbent community. You tell the company in the meeting, we cooperate, we belong to this pact, and we talk to each other, and nobody's going to tell you where to move, but we talk to each other and we favor the incumbent community having first crack at retaining you if they can. And we'll help you if it turns out that you can't stay there, but we talk. We're not going to be passively caught up in the prisoner's dilemma with the site location consultants whipsawing us against each other and passively with our hands behind our back allegedly representing taxpayer interests. We're going to talk because we know that people work all over the place and live all over the place in the region, that the effective unit of competition for economic development is the labor market, it's the metro area, it's not the community or the suburb or the locality. And then there's Sam Brownback, we're watching with, and the clock is ticking. Governor Brownback has until July to respond to an amazing offer that's been on his table since July of 2014. Thanks to the Hallmark Corporation, we shall feel much warmer and fuzzier when we walk down the aisle at the drugstore now at the Hallmark aisle. 17 business leaders led by the Hallmark Company 5 years ago, starting in the spring of 2011, began publicly yelling at Governors Nixon and Brownback And they said it, and I couldn't have written a better letter. They said, we are getting ripped off. We, the loyal employers who all have employees on both sides of the state line here in the Kansas City metro area, are getting ripped off by a small number of companies that are gaming you. They're moving back and forth across the state line where they're being greeted as new job creators and getting huge tax breaks, 8 and 9 figure packages, to the tune of more than $300,000 now. And we're getting stuck with higher taxes and lousier public services because these companies are gaming you. Quit it. Quit participating in this charade. And they prevailed upon the 2 Republican chambers in Missouri and Jefferson City and the Republican governor and the Democratic governor Jay Nixon to pass a law, a unique thing in the history of this issue in America, saying if within 2 years Kansas reciprocates, Missouri will legally agree to carve out the Kansas City metropolitan area and disqualify such interstate relocations within the metropolitan area for qualifying for tax breaks. But Kansas must do the same, and it must be legally binding. And there's been mixed media reports that things are bubbling over on the Topeka side of things, but it hasn't happened yet. It's up to him. And then there's the big accounting breakthrough that we could be the biggest thing that's ever happened in the history of this issue for us. So, how many people know what GASB is? Most of you. Okay. For those who don't, the Governmental Accounting Standards Board, an obscure organization that promulgates what are called generally accepted accounting principles for the public sector in this company. Sister of FASB, which does it for the private sector, and they're both projects of something called the Financial Accounting Foundation in Norwalk, Connecticut. We had been very critical of GASB for many years because they had never touched this issue, but that all changed about 15 months ago when they floated their first draft exposure draft for rules to require state and local governments to account for the revenue they lose to economic development tax breaks. We worked very hard during the comment period last winter, and then they came out with their final standard last August. It's called Statement 77, which is effectively an amendment to GAAP, the latest amendment, just like the Infrastructure Depreciation Amendment or the Pension and Healthcare Retirement Benefit Amendment, the OPEB Amendment. These are all accreted additions to GAAP over time. And it took effect last month, so we are now in the first year of Statement 77. That is for backward-looking comprehensive annual financial reports for calendar 2016 and beyond, which is to say fiscal 17. Every GAAP-compliant state and local government body, and that's not all localities, but it's most, probably 3/4, they will have to report how much money they lose to each economic development tax break program. It'll be accrued data. It's just $1 figure per program per year. But significantly here, for instance, in the intergovernmental free lunch category, school districts and other bodies of government that lose revenue passively as a result of the activity of other bodies of government, cities and counties creating TIF districts and abatements and enterprise zones, hurting school districts, the school districts will have to report. They'll have to figure out how much money they lose and report it. Huge news. So for everybody who has been arguing all these years that there's better things to do with this money, or that the opportunity costs are being obscured because all the politicians want to do is talk about the benefits and never own up to the costs, finally, in about 15 months, by the second quarter of 2017, we're going to start getting costs all over the place in ways we've never had it before. That's the big news. And with that, we can take it away.
Great. Well, thanks for this, Greg. It was hopefully eye-opening for lots of people here, and you've got a lot to say about the benefits and costs of tax incentives, but I would be remiss if I didn't point out that so does the Lincoln Institute. And on the back table, you'll see that we have one of our more recent policy focus reports by Daphne Kenyon, Adam Langley, and Bethany Paquin, talking about the impact and the viability of tax incentives to produce the kinds of outcomes we're trying to produce. And I urge you to read it because it's a good read, right?
Yes, we recommend it all the time.
Good. So, I want to, this is so, as an economist, of course, this is always a mysterious thing to me, why it is that people continue to do things that violate all sense of incentive structures, the cost-benefit analyses, and persist on it. And one of the things that Daphne and her co-authors point out in this policy report is that once a government gets used to providing tax incentives, it's like crack. They can't give it up, right? And in fact, they usually They usually do more of it all the time. And I'm wondering, how do you explain the fact that there's such an appetite for something that seems just so absolutely irrational?
Yeah, I sort of lay it out to the history of the way site location has evolved in the United States. In chapter 2 of my book, I talk about how, when big companies decide where to expand or locate, most of them hire consultants. The consultants are given the criteria, the business basics. That is, we need a lot of water, or a lot of software code writers, or a lot of cheap electricity, or some combination thereof. We don't want to be too close to a competitor. We need to be next to a big airport, or there's a matrix of criteria that go into the mix, and then the consultant sets about developing lists, and they pare down bigger lists to smaller lists over time, and then it's down to a set of finalists at the end. Maybe there's 3 to 5 finalists at the end. Often the company sort of already knows, or probably knows, where they're going to choose, but because of the ability to play places against each other at that finalist stage, they're not going to show their hand, and the consultant's not going to show their hand. What happens, the public officials, all they know is that somebody knocks on their door one day and says, I have a client, I'm not going to name them yet, but they might lay 500 jobs on your city. What do you got for us? And so the public officials' view of the whole process gets very distorted, because they think they can actually move the needle. They don't appreciate the fact that there's been a whole ton of analysis that's gone into the decision-making process before that knock on the door ever happens. And they have the business basics. They are an inherently profitable location for the company. The consultant never would have knocked on their door if that were not true. But because we have a system which basically consists of like money laying around on tables, companies feel remiss in not grabbing some money laying around on one of the tables, because it's there for the asking. The consultant will put that public official in the prisoner's dilemma. They'll say, now we're going to talk to some other places too. I'm not going to tell you who it is. You can't talk to them. You can't verify anything I'm telling you about what they're offering us. You just sit tight and get your checkbook out and write as big as one as you can, and we'll see what we can do for you. And that's so public officials' view of this whole process gets incredibly distorted, because they think they're actually influencing the behavior when they're not. All state and local taxes combined are 2% of a cost of doing business of a company. 98% are the business basics, and therefore you can almost never break a tie.
Yeah, I mean, it doesn't take a very sharp-witted analyst to take a look at the business model of almost any company and say, what are the important things the company is looking for, as opposed to a tax break that might account for less than even 1% of their revenues. For example, I don't know, disorganized labor, right? Mm-hmm. Because very often they're just trying to find a place to go where labor is cheaper than wherever they started. But in many other cases, it seems that all it is like frosting on the cake for the company itself to just get some additional kind of benefit, or else, and this is my own pet theory, it's actually, there's a political economy kind of view of it, that the companies are just wanting to see how much leverage they have with local government, because they expect, in a kind of game theoretic way, mm-hmm. to be able to ask for other stuff later. Mm-hmm. Right? And they can also always hold the local government hostage with the threat of leaving once they've gotten themselves established, so they can then begin to ask for other kinds of concessions. I'm not sure, but what's your view of that?
I'm very persuaded by that. I mean, if you read the case studies of successful wooings published by groups like the International Economic Development Council, there's all this verbiage consistently about sending business-friendly signals. Rapid response, user-friendly websites, quick tours, customized labor market information. It's all about being business-friendly and jumping as high as they say when they say to jump high. So yes.
But then if you think about it, I mean, certainly the competition to get a company to locate, say, within a state, so it's trying to steal somebody from Worcester to come to Boston, it's a zero-sum or a negative-sum game for the state, and it's probably for both of those jurisdictions, right? So you could see from the state's point of view, they would definitely want to suppress that kind of activity at the state level. However, stealing companies from one state to the other would be more appealing for a state like Texas. Right. But why wouldn't a state just do it by changing their corporate taxes?
Well, and I mean, the theory would say that might do it. I just want to back up a minute. So in one study, we documented the fact that at least for one major incentive program, 40 of the 50 states say you can't use that program to move around within the state. The trouble is, many of the most common kind of bread and butter programs don't have that safeguard attached yet. But the idea is very well established in 80% of the states. The trouble is nobody will, except for Missouri's offer to Kansas, will extend that idea across the state line yet.
So do you think that if you put these kinds of decisions to a referendum vote in your average town, city, or state, the voters would choose not to provide tax incentives to attract big businesses, or would they?
History teaches us that they're quite unpopular. The history in Minneapolis, for instance, of defeating ballot initiatives for stadiums, sports stadiums, suggests that. The Washington Post just did a big piece on Chris Christie's flailing efforts to save Atlantic City. They missed a big story, a voter suppression story here, where there was a proposed huge subsidy for to revive a failed casino construction project, the Revell, $250 million offer that Christie came up with. The local union of gaming workers said, we don't need more capacity here. We already have too many other competitors in the Northeast. That would be the worst thing that could ever happen to Atlantic City. And they found that the law pertaining to this program allowed them to put it on the ballot. They petitioned rapidly to put it on the ballot, and within 3 days, the New Jersey legislature retroactively stripped their right of putting it on the ballot.
So now if voters generally are opposed to these kinds of tax incentives, and voters, at least allegedly, vote their elected representatives into office, why do they keep these representatives in office when they continue to do things that the voters don't even find appealing?
I think that's the genesis of why so many things get delegated to appointed boards. In fact, part of me wants to, in my retirement, I'll dig up the papers where the site location consultants like Fantas, I think, probably advised cities like New York City to create these obscure appointed bodies that meet in closets on days advertised in 6-point type in the legal briefs of the New York Post on Saturday to give away tens and hundreds of millions of dollars. And that's the system we blew up in New York with our project there. But I think one of the reforms we always recommend is that elected officials have to actually vote on the deals, because in way too many places they don't.
So then, in theory, this whole effort at accountability and transparency would eventually kind of reflect in voters expressing, at least to some extent, their interest or their lack of interest in tax incentives and a lack of interest in elected officials who provide them.
I think so, and I mean, we would love to see somebody play offense on a ballot initiative on this. I think you could argue, I think if someone were to float a ballot initiative saying every deal above, $20 million would have to go to a vote, that would pass. And then you'd have a vote on every major deal. And I doubt many of them would pass.
So I want to turn to kind of a slightly different take on the topic, which is, I'll just put my cards on the table. I think we actually know a lot less about economic development than we think we do. And certainly one of the things we do when we start to analyze efforts to do economic development, we can come up with metrics like how much does it cost to create a job? And certainly you've been able to establish very well that it costs an awful lot to create a job through these kinds of tax incentives. But I was thinking back and I was looking at some of the analysis of the Recovery Act. Mm-hmm. And some of the analysis of the Recovery Act came up with similar numbers for our other kinds of policy approaches to creating jobs, like putting whatever it was, $785 billion out in the street as a way to kind of get the economy moving during the economic crisis. And as I recall, before in my office, I was trying to pull up the number. I couldn't get the exact number, but it was running at one point at least, and I don't know if the final numbers are in, at about $400,000 a job from the money we put out from the Recovery Act, which looks like it's just slightly more efficient than tax incentives. But to the extent that everybody's kind of operating in the dark, trying to figure out how do we actually gin up local economies, how do we create some jobs, how do we do these things? What are better alternatives for local governments to think about that will produce the results they're actually trying to look for that they're not getting through these tax incentives?
Yeah, so there's all these alternative small business networks out there now promoting variations of what's called economic gardening, which has to do with import substitution and local supply chains. and promoting entrepreneurship and targeted anti-poverty programs with entrepreneurship to targeted populations. I like all these strategies a lot. I mean, on the incentive front, we would say right away, get rid of all the but-for and baloney about that, and just narrow the eligibility rules so that you're really addressing market imperfections. And we're comfortable with those. If you want to give me a subsidy for a grocery store in a food desert, or help a returning felon get a better job, or clean up a brownfield where there's no more responsible party, I think that's a good thing. Let's do that. And let's integrate it with the other strategy, other retail amenities around the grocery store, whatever it is the neighborhood needs. But narrow the eligibility so that you're demonstrably meeting a market imperfection and nothing more. Close it off at that funnel. And then, look at Burlington, which has this long history of doing this multi-pronged economic development strategies of downtown revitalization, lakeshore restoration.
Burlington, Vermont. Burlington, Mass.
Yeah, Burlington, Mass. Yeah, exactly. This big, agricultural area preserved right next to the city with, farm to fork, linkages, all kinds of female-centered and immigrant-centered entrepreneurship strategies, renewable energy, through the local utility, municipally owned local utility. There's lots of models out there. Most of them are not very big scale yet, and a lot of them are in smaller cities, it seems like.
Yeah, and I think that it's like I said, it's an ongoing challenge, because let's say, for example, your real goal is, I want to find a way to reinvigorate an older industrial area that's been dead or dying for a long time. Anthony and I were just in Connecticut yesterday, and Connecticut has a lot of relatively small cities that were built on older industries that are still there, but their industrial sections are still moribund, right? Mm-hmm. But it probably doesn't do anybody any good if they were able to attract some industry from Holyoke, Mass, to come over to Waterbury, Connecticut, right? Reinvigorate their own little industrial area, and then leave a vacant industrial area behind. So I'm wondering, there must be, and of course this goes beyond like most of our expertise. There must be another way, right? And that other way might involve actually finding a way to cultivate new industry and growing it locally. And one would hope that there's an opportunity to do something like that in the U.S. coming up. All right, so the last topic I want to talk about before we kind of open it up to the audience is this idea of clawbacks. Mm-hmm. Because in theory, the clawback provisions sound pretty good, although I can't remember a single time I'd seen a clawback actually enforced. So first of all, have you ever seen a clawback on a tax incentive given to a business actually enforced, and what was the outcome there?
Oh, yes. We grade some states in our disclosure website and our clawback study, both we graded states on whether they disclose clawbacks actually getting triggered. And so Texas and Illinois stand out as states. And we did a big thing on this early in the recession, when predictably lots more companies were falling short on their promises and therefore triggering clawbacks. And the number of reported clawbacks on both those states' websites were about tripling at that in 2009 we're talking. And we pointed out that the sky didn't fall. Nobody claimed that they lost their business or that Rick Perry's business climate was not getting poisoned at the time by what was going on, and things went on as usual. New Mexico's had some big clawback episodes as well.
So give us an example. So what actually gets clawed back, and do you know, like, even a single company that was forced to pay back to a state some tax incentives because they didn't create the jobs they promised?
Oh yeah, we'll send you links to many that have been reported by those state disclosure systems, sure.
Because I wondered, doesn't that send a chilling effect to your location specialists who would say, well, gee, maybe we don't want to go to that place if they're really more aggressive at clawing back on these promises?
No. In fact, in 2004, I shared the dais with a guy named Gene Dupre, who is arguably, at that time, the second most famous living site location consultant in the United States, and now probably the most with the death of one of his colleagues. And I did my spiel about safeguards, and then he opened his and this guy works for the global Fortune, like 1,000. He opened his spiel by saying, Greg's right, I tell my clients to factor the liability into their calculations on the deal and just carry it on their books as a liability until it expires, whatever the deal is, the 10 years, the 5 years, whatever it is, and just get over it. It's there. Get real with it. Get used to it.
And he thinks that. Well, I guess that would be that's rule of law. That's people honoring contracts that they agreed to, and even if the site consultants kind of are philosophically kind of proponents of that, I guess that's a good thing.
Right. I mean, in fairness, if you read our clawback study, we criticize some states for having squishy discretionary language about pulling the trigger, and we think that's dumb. That's the biggest flaw in this construction of them. We just think they should be even-handed. It should just be black and white. Everybody should know where they stand. Redeploy the money for another deal.
All right, so we're going to open this up to the audience if anybody has comments or questions to make. I'll just offer just a kind of one closing thought. It seems to me that in modern times we've become much more short-sighted, right? We want instant gratification. We want answers now. We want things to happen immediately, as opposed to being understanding that maybe some processes that we want to kind of create and help to unfold are longer-term prospects. And it would seem to me that these kinds of tax incentives fall squarely into that instant results kind of category, which generally are built on fantasy, not on reality, right? And maybe the truth is that the reason we don't know that much about good economic development practice is because we're never willing to sustain the effort long enough to actually see things come to fruition. And so maybe the answer is to be a little bit more disciplined. And certainly I would agree with you that shedding more light on these processes and giving the average voter or giving even the average public official the ability to really weigh the costs and benefits of the kinds of incentives that you would use to promote economic development is a good thing, right?
Yeah.
So obviously.
That's absolutely where we're at with the disclosure. We want our public officials to be as well equipped as possible with as much information. We don't want them with both hands tied behind their back. And we want lots of people looking over their shoulder too. And that's the whole point. Absolutely.
All right, so we have lots of people looking over our shoulders, so we'll start over here.
Well, getting local, Boston has had two major tax deals over the last 60 years. The first was Prudential, and the second one was 2 weeks ago with General Electric. So,
amazed nobody's asked that.
So my question is, do you have any sense of those? And I don't know that we don't have job information, I don't think, on the 121A deal that was done for Prudential. And we don't know nothing about GE. But looking at the larger picture for both of those of what Prudential did to the psychology of Boston and what we think GE may do to the psychology of Boston and to subsequent businesses, how do you begin to look at those kind of individual kinds of projects? Versus your very broad thing, which is, I think, 100% correct. But I think every once in a while you get some things that make sense.
So I won't opine about the psychology of Boston. I'll as the outsider, but I'll say this. Part of me wants to frame General Electric's press release announcing the deal, because it was really clear, both from that and from lots of other data points, that they wanted to be here because of the executive talent pool and the infrastructure, but especially the executive talent pool. And subsidies were kind of an afterthought. I mean, I really suspect state and city overpaid for the deal, right? 181 grand per job is a lot of money. It's the biggest deal in your state's history. So I've spent a lot of time trying to educate reporters about this. And I think the other dynamic you see going on there is corporate headquarters moving back to downtowns. This has been a documented trend, right? Businesses generally, including headquarters, want to be in the hubbub. There's that famous book chapter by William White, the sociologist who coined the phrase suburban sprawl, who looked at a bunch of companies that fled Manhattan for suburban Connecticut in the 70s, during the darkest days of New York City when it almost went bankrupt. And then he revisited them 10 years later, and he noticed that by comparison, the companies were less profitable, more likely to have been the subject of hostile takeover, losing their edge because they weren't in the hubbub of Manhattan anymore. And General Electric's fleeing suburban Connecticut is like a very trendy thing right now for corporate location behavior, I think.
Well, I've actually worked in the field of economic development for many, many years as a consultant, not as a site selection consultant, but so I've done a lot of thinking about this. So when you bring up a deal like the GE deal, another thing to keep in mind is GE and probably 95% of those companies that get those incentives, especially the big ones, don't need them. They don't need them to be competitive. So you're giving them money that they don't need to compete with other states. So, but when you say, well, why don't cities and states get smart, and if they realize that they're just losing this tax money? I mean, the other side of it is number one, they say they probably know that they don't need to give the money. I mean, that the company doesn't need the money, but they're going to say, and it's what they said in Boston, and it's what they said when we were talking about the Olympics. Well, if we give these big tax incentives, it's not a loss to us, it's a gain to us, because we wouldn't have gotten that deal if we hadn't given the incentive. And who's to tell them that that's not true? And if they're thinking, well, if I lost the deal, whether or not it was because we didn't give a package or not, we're going to get the blame. So they don't get a lot of pushback. Like in Boston, which is a fairly sophisticated, we have public policy groups that look at these things, and there has been a little bit of pushback, but basically nobody's going to say, gee, this was a bad deal for us. And you're talking about the public revolting against it. People don't. So I think the states and the cities, they know their pockets are being picked a lot of times. They might not even like it, but they know they have to do it to play the game. So I see like how, what is the way of addressing this? Because and when you say what's economic development, I would say this is absolutely not economic development. This is the opposite of economic development. The way we define economic development, or the field defines economic development, is absolutely wrong. So we're in this, and we're spending $70 billion of state and local money on nothing. And we know we have all these other needs that haven't been met. I have a couple of questions. It's like, how do we, go ahead.
Well, two observations. I mean, you're hitting on a key teachable thing everyone needs to understand. At the end of the day, you and I as taxpayers, nor our representatives, can ever peer inside the black box that is the company's decision-making process. We can never know what really matters. We're always going to be forced to take at face value whatever representations they make about cause and effect. As long as that's true, the bargaining power between public and private sectors is highly asymmetrical. The other thing is, in decision-making theory, right, we know people will spend much more energy to avoid negative consequences of a decision than the opposite. So they'll overspend to avoid being the governor that lost General Electric.
Yeah.
But if you zoom out, I mean, and you ask, gee, first of all, how much worse would Boston be without GE? It might be very hard to to quantify that. Then ask a kind of a slightly different question, which is, what good does it do bringing, say, GE to a place that has an overheated housing market, very low unemployment, and huge amounts of contestation for the available space? It's like, why would anybody want to locate a business in San Francisco anymore? Which is also, by the way, very expensive to do business,
Yep.
right?
Yep.
And it occurs to me that that's really in the aegis of a national government, not even a local government, because a national government looking at the way things are going, right, and it's saying, well, gee, why is all the wealth, all the talent, all the really good jobs gravitating to a few small places like Boston or New York or San Francisco or Seattle, right? And why are we kind of hollowing out the rest of the country? And if we're in a country that actually had, say, industrial policy or urban policy, maybe we would do something differently. And the case in point in this is Germany. Because in Germany, when the car economy collapsed, when lots of pressure was put on the steel industry because of new entrants like China and Korea, Germany didn't just let the market decide what was going to happen. The German national government sat down with people in the province of Bavaria, and they sat down with the industrialists, they sat down with the unions, and they sat down and they said, how are we all going to work together to make sure we maintain Germany in kind of the global trade markets, and what are we going to do to make sure that happens? And everybody gave concessions, but it wasn't as if the concessions just came from local government to keep BMW where they were going to be, right?
The other short answer to your final question is means testing corporate welfare. I mean, just narrow the eligibility for these programs so the General Electrics of the world don't qualify to begin with. Just get them out of the trough.
But Greg, do you see any role for the national or the federal government to actually step in and just say, you know what, this is a destructive process. Maybe we need to find some way to kind of make it stop, right?
Yeah, so having been stung by the episode of the Cuno v. Daimler Chrysler Supreme Court case, the Dormant Commerce Clause constitutional lawsuit, which I will explain if people want, but the takeaway is the Supremes don't understand how states tax corporate income. Only Justice Breyer didn't have to have his questions corrected that day when the case was argued. Even if the Supremes had done anything good, Congress was ready to undo it because the Commerce Clause says Congress shall regulate commerce among the states, and Congress was ready to legalize everything we hate about the system and more. So my bright idea is to build on the precedent of how the states raised the drinking age by holding back 10% of the highway trust funds until states raised the drinking age to 21. That was a precedent that was upheld at the Supreme Court level in the 80s. I think you could take the HUD block grant program and set aside 10% of the HUD block grant program and say states are not going to get the rest of their HUD block grant money until they do two things. They have robust disclosure, recipient online and outcome disclosure. They get an A+ on our report cards, and they agree that the governor signs a certification that he will not actively pirate jobs from other states. And I think we could move mountains that way, and it could probably be done by executive order, or just even, I mean, there's already some discretionary pots that the Department Housing HUD Secretary has already.
Yeah. Right. So Martine, I see you waving back there.
A couple of comments. One, have you been looking also to other kinds of incentives, like donating land that is owned by the jurisdiction? I know that, for instance, that ThyssenKrupp, when they got into Alabama, they got an island as a gift, literally. So this is one that whether these other kinds of indirect incentives have been on the table as well. The second thing is Boston has recently rejected the idea of hosting the Olympics, right? That's on similar types of argument. This is a smart. To some extent, this is a positive thing. There has, I guess, right? There was they leveled the whole, they put the numbers on the table that they didn't put, right? But I know that there are some decisions like that are on mega projects that are also very difficult to assess, like hosting the Olympics in general, or the World Cup and soccer and stuff like that. And there has been some other types of variables that they put on the table to evaluate that. Not only the strict money in, money out, like what does it change, or what does it do with self-image or things like that. And for instance, in South Africa, apparently they realized that the number of suicides have gone down after the World Cup for self-stigma. This means, and how you measure that thing compared with how much your GDP you would have to increase to reduce the suicide rates at the same level. That's in kind of an indirect way of measuring that. That's what we.
So we at Good Job Source have not done studies on land-based economic development strategies. I mean, I certainly know that land parceling is a big issue, especially for urban redevelopment projects. It's a big issue in tax increment financing. Governor Pataki that $1 million per job deal I showed you in the microchip fabrication plant, that was thanks to Governor Pataki's shovel-ready siting of a big piece of land that he got ready for the big footprint required by these sprawling microchip fabrication plants that are the style these days. I'm also enamored of cities that I know have done projects where they try to do, especially in distressed neighborhoods, where they try to do very meticulous inventories of all the land owned by all the different parts of a city government. So all the ones that are not just owned by the tax assessor for tax delinquency, but those that are owned by the housing authority and the transit authority and the water and sewer department, and et cetera, in a way to help create parcels that are suitable for redevelopment projects. I think that's a smart strategy as well.
Indeed.
And I don't have any insights on sort of civic psychology about the Olympics. Sorry. It's a stratosphere by itself.
I'm interested in local government subsidies. What does the data show about the mix between subsidies on the spending side, building infrastructure and so forth, versus subsidies on the tax side, property tax or other tax?
Sure. So the question is the mix of subsidies, appropriations versus taxes. To the extent we know, and we have about 7 or 8 what are called unified economic development budgets at the state level, not local, that it's very lopsided. It's not wrong to call tax spending the bottom of the iceberg, 4-to-1, 6-to-1, 8-to-1, foregone revenue, tax breaks versus appropriated expenditures. At the local level, I think it's probably not quite so lopsided because they've only usually got one type of tax to play with, the property tax, sometimes the local sales tax increment. But we also make the point that one of the big deals about GASB is the fact that property tax data is so dispersed and therefore poorly researched and understood. But it's often the biggest single incentive that a company gets because property taxes are often the biggest single tax a company pays.
Local tax, right?
Yeah. It's a big deal.
Hi, I'm in the Massachusetts legislature. I serve there, and I have, I think, a little bit of insight into that black box. I can't tell you about the corporate one. But what I see after a decade in the House is that there are very few members who come to the job with a background that where they've had to learn quantitative skills. So that's a very weak link there. There's also a tremendous amount of ideology that rules. We are not in the slightest data driven, and even when we had a vote on capping, say, the film tax credit based on a study by the Department of Revenue that showed subsidies of something like $114,000 per full-time equivalent job. There were members of the supposedly hard-headed minority party standing up and saying, I can't believe this data. I have to believe what I see with my own eyes, which is, they filmed a movie in my district and everybody got excited and all the coffee shops were full and this kind of stuff. The press does not report much on this phenomenon at all other than to say, yay, GE. The speaker got up yesterday in his State of the State and wanted to congratulate every member who had done anything to create a climate where GE would want to come here. And it might not have been in their press release, but they certainly slammed Connecticut tax policy on their way out the door. So Massachusetts is feeling puffed up and reinforced in all the things it's done to cut business taxes and provide seemingly limitless subsidies. And we've had commissions to look at the tax expenditure budget. No reporting. The public knows very little about these subsidies. They know really nothing about the really exotic ones like TIFs, which we call DIFs in Massachusetts, or EQ'd, which is this scheme to issue bonds backed by future tax revenues, which if they don't realize, the municipality is on the hook. And in any case, those future revenues, instead of going to the community or being diverted to pay the principal and interest on bonds. And if you try to talk to a reporter, and even back when the Globe was a real newspaper, if you tried to talk to a reporter about this stuff, they'd say, "Oh, we can't do stories like this. Our readers' eyes glaze over." So I think that there's a lot of sort of consensual dumbing down. You know, people agree that not to have to think too hard about this, and to applaud anytime some elected person comes out and says, "Oh, I brought this many jobs here," and if you can suggest a way out of this this racket, I'd love to know it.
So could I ask you a question though first? Do you think there's an appetite among your fellow legislators to learn more on the quantitative side about these things, and if it's packaged right, they would be willing to kind of open their minds to understanding more about these kinds of issues?
Some of them, yes, but even with this great opportunity today, I sent the invitation to my House and Senate chairs of the Joint Committee on Revenue, in which I am the only woman from either branch, and I said, you probably know Greg LeRoy's book, Lincoln Land does fabulous programs, let's all go to this. And everybody was busy doing something else, I guess. But, I'm thinking, well, I'm either going to get a link. Is this on the website? I can just send a link to
This report?
Yeah.
Yes, it is. Yeah.
Okay, so I'll send links to the report, and I'll send a little email around to the committee saying, I went to this excellent program. Maybe we should invite Lincoln Land to come in and do a legislative briefing on tax breaks.
Well, we stand ready to do that anytime you want to invite us. Right?
Me too.
Okay.
Yeah. We'll bring Greg along too. Yeah.
Thank you.
Thanks.
Well, bless you for all you just said. I mean, there was a very comprehensive reform package put together by Senator Eldridge here 5 years ago that we helped him with, and I testified about, and it had 55 co-sponsors, and then I guess in your very top-down structure here, it just didn't go beyond committee that day. We had like 8 of your fellow members of the legislature testify with me for. I don't quite understand. As a state that is kind of stereotyped as an advanced industrial state, I was actually appalled at how primitive your incentive rules were when I put my testimony together. You guys were very late to enter the disclosure, and you're still very incomplete on disclosure as well.
So maybe a slightly different point of view. I work for Governor Baker's administration in economic development. I was closely involved in the GE deal for the last couple of months. So, I would just say, first of all, I agree with almost everything you said, except your comments on GE. I was felt my chair when I saw some of the sizes of those deals up there, multi-billion-dollar deals. And I would say, as an administration, our strategy is not an incentive-heavy strategy. So the governor yesterday filed a near $40 billion budget. Today filed an economic development bill. Our economic development incentives, our economic development incentive program is $30 million a year. Our mass life sciences tax credits are $25 million a year. Yep. So this is a $40 billion budget. So we don't lead with incentives, and I don't think we're an incentive-heavy state in that regard.
That's objectively true. I agree with you.
And I liked your phrase, economic gardening. That's a pretty cool phrase, and actually characterizes a lot of what we're trying to do, which is grow companies that are here today and set the conditions for growth, versus trying to grab companies from other states and trying to be incentive-heavy. So I like a lot of this stuff a lot. Just quickly on GE, it's the fact that there was one other big deal from Boston mentioned, I think says this is an outlier. It's not what we do typically as a state, or not to speak for the city, or as a city. We looked at it, frankly, as a once-in-a-generation opportunity to land a Fortune 10 company headquarters, which never happens, with all the follow-on effects from that. And I would just point out from the state perspective, our incentives, $120 million, are for infrastructure. It's not tax breaks for the company. And now, having understood better what other states do, I would characterize their incentives are as taxpayer cash in shareholders' pockets. That's not what we're doing. We're trying to provide incentive infrastructure money to help grow GE here. So I think it was a fabulous deal and a smart deal that'll pay off for us over time.
So when you think of the list of benefits that Massachusetts or Boston would get, by attracting GE. What are like the top 2 or 3 things on the list that you think are going to be happening?
Yeah, it's a great question. Look, 800 very high-paying jobs, so an enormous payroll. And you can do the math in terms of state income tax. And the word of state income tax breaks for either the company or the employees. But that payroll over many, many years, that's a big part of it. It's a large company and an innovative company, and what it will do for our technology ecosystem here, I think, is substantial. So I'd probably highlight those 2 in particular. But it's and it makes a statement, I think, about Massachusetts. I do want to frame the press release too. It's quite a press release, and it made clear they came here because of who we are, not for the incentives. And we've got a pretty good sense that our incentive package was much lower than other states, by the way. But I think it says great things about Boston and great things about Massachusetts.
Yeah, I mean, that's a challenge to journalists. The point you just made, I think it is true that the offer, at least from New York, was bigger, probably some others, and I hope reporters will now FOIA those packages and will get that out, because it's hardly the first time a company took a smaller incentive package.
And I just wanted to make a comment on the Boston deal as well. There was only one Fortune 50 company left headquartered in the city of Boston, and that was Liberty Mutual, so this makes number 2. We'd lost a number of them with all the consolidations that have gone on over the years.
So two of the other states that were GE was negotiating with that were listed in the paper, Texas and Tennessee, do not have personal income taxes. So if the executives were just looking for a tax break on their own personal W-2 form, they could have moved to Texas, which doesn't have a personal income tax.
Would you tell Arthur Laffer that, please?
Yeah. But now, do you think that the magnetism that attracted GE to come to Boston is enhanced by having GE here, or is it diminished? Will it keep other larger companies from coming, or because there's an opportunity cost of landing something like GE, because it might splash other people away, or it could become even a stronger pull to bring other people in?
I think it's going to be a very strong pull, actually. I think companies are going to want to become closer to GE, whether it's companies in their supply chain, their partners. It'll absolutely be a pull.
Yeah.
Mac, I really appreciate your comment questioning whether or not we even want 800, 900 more high-paying jobs in the area. As someone looking to enter the for-sale housing market,
Finding a place to live is a challenge.
sorry, the main issue facing Massachusetts people, I mean, housing costs are a much bigger issue in the Boston area. And no one wants to do anything about that, and that's a different topic.
I don't know if that's true. I mean, the mayor just put out a major policy issue for rent control.
It's going to make no difference. It's not even the most populous county in the metro area that Boston's in.
Well,
but my question is, do you see, so I'm originally from Ohio, and I know Kasich really talked up what he considered a revolutionary new economic development plan, which I believe was, in a creative way, partially privatized. And there was a lot of criticism that is much more opaque. I'm curious kind of your thoughts about that. I haven't done as much work as I'd like to understand it. But a more general question is there sort of a partisan or philosophical difference you see based on the personality or the politics or the party affiliation of the people in power in a given state and the approaches they take? Or is it once they're in the state house, it all starts kind of looking the same, or it's really practical realities that shape?
I think it's mostly the latter, what you just said. But look, jobs have gotten hyper-politicized for the reason I laid out at the beginning about deal flow has been depressed for such a long time. And one response by a lot of Republican governors has been to bring the commerce function even closer to them. So that when Kasich created Jobs Ohio, the privatized agency there, the joke was you couldn't tell the agency from his office. And you couldn't, right? Because you create a captive C3, the governor either chairs the board or appoints all the members. It's on a very short leash. Anything good about the state they want to own immediately as coming from the governor. We published 2 studies on the perils of privatization of state economic development agencies. The most relevant one is called Creating Scandals Instead of Jobs, so you can see where it's coming from, October 2013, where we looked at Wisconsin with the Wisconsin Economic Development Corporation created by Governor Walker, Texas with Governor Perry's creation, the new one that McCrory was about to create in North Carolina, the very old one in Florida, and it was like Groundhog Day writing these case studies because it's just a blueprint for mischief, if not corruption. Wisconsin is the biggest train wreck of all. I mean, it's weekly problems up there practically with the Wisconsin Economic Development Corporation. It's been a huge sore spot for the Walker administration. We take credit for actually having slowed down and substantially altered what eventually occurred in North Carolina, and right now we've also helped gum up the works in Illinois. Rauner's been trying to privatize his agency. It got through the House, it defeated in the Senate. We know everybody's read our study. We testified about our study there. So we think it's, but if you look at the history of the big deals, by any governor of any stripe, they were all done by, the vast majority of them were done by public sector officials. Tell me what's broke, is what I keep saying to reporters. Everybody knows that the velocity of this work has accelerated. Everybody knows you have to be business friendly and do all the rapid response stuff I talked about. That's been true in the profession for a very long time. And the user-friendly websites and the customized labor market information, all that jazz, plus the check writing. It's not broke. Public officials land big deals all the time. Show me a governor that ever lost a deal because a public employee didn't return an email quickly enough. Nobody's shown me one yet. So that's otherwise than that, I don't know how I feel about them.
So we probably have time for a couple more. Is that right? Okay. Yeah, back here.
I love your great comment about development incentives sometimes being justified if there's a market failure that needs to be corrected. Are there occasions when infrastructure investment as part of a development deal can be justified on the basis of market failure, and when is it just kind of infrastructure for private interests?
Well, great question. But the broad answer is yes. And I mean, certainly at the top of my list of opportunity costs are infrastructure and skills development and training, because even if you do infrastructure that's mostly to benefit one industrial park or whatever with one dominant tenant, even if it doesn't work out with that dominant tenant, the infrastructure is still there and hopefully will get reused by other tenants later. And if you train a worker who ends up getting dislocated, at least they've got the skills and they're not likely to leave. You're still going to capture the benefit of the training you gave them. So always at the top of the list would be those things. And yes, I mean, obviously there are certain kinds of infrastructure that's extremely favoritistic, and lots of TIF programs are structured in ways that are basically just writing checks to pay for private construction, not even public goods, and we don't like that. But generally infrastructure we like a lot. And the GASB rules are going to require disclosure of associated infrastructure spending with major economic development projects too. That's another positive aspect of the GASB rule.
Do you happen to have any data on public-private incentives? For example, some of the job creation partnerships that Germany has done in the United States. Any examples? Because what you mentioned is privatization, essentially.
Right. Like the Works Council in Chattanooga, you mean, with Volkswagen?
Something like that, or for example, where there is a manufacturing element with a town that, for example, in West Virginia, there's a cabinet factory that's gone into West Virginia, and they have been incentivized by the town essentially, but they've actually gone into partnership because the unemployment rate was so high that they had to do something.
I'm not familiar with that. I mean, I think it's interesting that we were critical of the Haslam administration and those people who try to interfere with the union election in Chattanooga when Volkswagen sent very clear signals that it wanted a union there because they wanted somebody to plug into their Works Council structure. It's the only plant in the world they have that didn't have that yet. And incentives actually became part of they pulled a bunch of incentives off the table on the eve of the vote there for the second line, for the expansion of the plant. We didn't like that at all. We blogged critically about that.
I had a very short question too about your remark on referendums, because you paired your data with other controversial type projects like casinos and stadiums and so forth that have sort of externalities that are not necessarily ongoing, quote, legitimate businesses. And I wondered if you would get the same result if you polled the public based on a company that would be considered to be ongoing and not of that other type.
It's a great question, and we just don't know because we don't have enough history on these votes. I mean, there certainly is a high road strategy for casinos, and it's called Las Vegas, and they're unionized, and they've got fantastic ripple effects, but you compare it to Biloxi, and it's like night and day. Right?
Thank you.
Sure.
Okay, one more.
To other countries that have similar federative structures that also have dealt with the issues and have resolved some of these predatory consequences of that?
Well, and I'm sorry, Professor Kenneth Thomas, who now resides in Boston, who's the source of our 70 billion estimate, is an international comparative scholar on subsidy regimens. And he's written a lot about comparing US and EU and Canada systems. And, you know, I wish he was here to give us our elevator speech about the EU system. But suffice it to say that the signatories of the Treaty of Rome in the EU system have a much higher degree of cooperation among themselves than do the 50 states of America. Under the EU system, there's rigorous definitions about what a depressed area is. There are rigorous caps on what's called aid intensity, generally capped at only 25% of the capital cost of a project. We have projects here that exceed 100% in America. There's a system that really encourages companies to rat out each other for violating the rules, and there's an active dispute mediation process tied to that. It's a whole different world, and much stingier.
All right, one last comment. Make it short, though.
One quick one, yeah. My understanding is that when you look country to country, I think it's WHO, there are laws against countries offering incentives to corporations. And so, you know, the other country can bring them to court for that. So, for instance, if the U.S. government gave us, I don't know what it was, a $7 billion incentive to Boeing, Airbus could come and bring them to court. Why isn't that true at the state level?
Because there's no Commerce Clause violation, according to the Supreme Court, at least as current jurisprudence stands.
But wouldn't foreign countries say, let's go to the WHO and contest this?
WTO.
Yeah.
Airbus has sued, and I'm sorry, I could tell you the best lawyer to talk to on this. I'm not a lawyer.
Yeah.
There have been suits about those, and I don't think they've meant very much ultimately.
All right, well, we've
Great
kept
questions.
you about 10 minutes too long. It's been a great conversation.
Thanks for your patience.
Join me in thanking Greg.